Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the market's a little under the weather today. The Nifty is down close to around 50 points. The Nifty Bank, though, is faring relatively better. And plenty of stocks on the broader markets actually are doing a thing of their own. Hey, Mangalam.
It's been the case, right, Nigel, for the last few trading sessions where the frontline index behaves in a bit of a range, consolidates. There is volatility, no two ways about it, but it is range-bound. And in light of that, we have the broader markets which continue to do well. So your portfolios look a lot better than what the screen would show you. Let's get in some ideas for profit. Then Bharat Jinani joins in with a stock that he's been tracking. Bharat.
Today's idea is Cello World Limited. The company posted better than expected performance in Q4 with the revenue growth accelerating to 15% YOY. The commencement of the new glassware facility at Rajasthan and improved consumer sentiments led to the strong performance. The company expects the growth momentum to continue and has guided for 12 to 15% growth in the current fiscal. The company will continue to introduce new products as well as SKUs to drive the performance. The company is also deepening its network presence and also ramping the modern trade and quick commerce segments. The recent BIS quality norms introduced by the Government of India on steel bottles is expected to curb the imports, particularly from China, and lead to market share shift towards domestic branded players like Cello World Limited. The company is ramping up its production capacity. The new glassware plant at Rajasthan is ramping production, and the company is also planning to set up a new manufacturing facility for steel bottles. The extension of the BIS norms to other consumer wear categories would be a significantly positive development for Cello World Limited. The company has a strong balance sheet with a debt-free status and a healthy cash flow generation. This would enable the company to tap inorganic growth opportunities and boost the growth momentum. The company is also looking to reduce inventory and improve the overall working capital cycle. At the current market price, the stock is trading at a PE of 30 times FY27 projected earnings. Investors can add the stock with.
All right, thanks a lot for that. For the time being, though, I'll tell you what, we'll slip into a short break. We've got a couple of big managements lined up for you on the show. So we'll take that break, we'll come back and get chatting with one of them. Welcome back. Well, the breadth of the market is still positive, and we have a couple of stocks actually that are doing very, very well. One such name that's doing well in today's trading session is the new kid on the block. We have Belrise Industries that listed today. It listed at around 100 rupees, which is a premium of around 9% in comparison to its IPO price. And the last time that I checked, the stock was still trading in the green with a gain of close to around 4%. To help us out with the outlook going ahead, we're joined by Mr. Sumedh as well as Mr. Swasthit, who joins us on the show. Hi, gentlemen. Good morning and congratulations to y'all. Recall having a chat with y'all, when the IPO opened up. And it seems the street is extremely excited with this listing because volumes are massive and it's been a good first hour of trade for y'all. Let's get a couple of numbers, though, out of y'all. As y'all promised, before listing that y'all will have the liberty post-listing. So either of y'all can take this question. Sure. Y'all mentioned that y'all have outgrown the industry and y'all are quite optimistic about growth. So tell us what kind of growth can we look forward to FY26 on whatever kind of base that you deliver in FY25 and split it up for us. Throw in some color out there. What could the revenue mix look like and how much of it will come in from exports? Go ahead.
So I think we will not be able to give a particular guidance for FY26, but we feel in a medium term, we want to continue outperforming the industry like we have done over the past 8 years or so. We expect to grow much faster in the industry going ahead. And this will be done through a mix of organic and inorganic. I think organic-wise, we have 3 plants coming up, as we discussed last time. And apart from that, the inorganic acquisitions of H1, which was recently acquired, we feel will have very strong tailwinds going forward. So expect outperformance of the industry to remain the way it has in the past.
What kind of growth are you working with for the industry?
In the two-wheeler industry, we expect, based on CRISIL numbers, we expect it to grow at 7 to 8% CAGR.
And normally you'll outperform by how much? 2 times the industry, 1.5 times? What is it?
I think in different years it's been different. So.
Okay, you know what, Swasthi, I'll try and help you here. Because the last time Sumedh joined us with your father as well, he said that over the last 10 years or so, the industry has seen volume growth of almost 1.5%, whereas your revenues have grown by about 10%. Now, volume and revenue are not directly comparable, but if you could give us a sense, if you're expecting the industry revenue to grow by 7 to 8%, then how much higher can you typically grow?
I think going back, I think we will not be giving guidance for the immediate term. I think in the medium term, we expect to outperform the industry considerably.
Your CAGR has been 10%, 10.5%. Do you expect to outgrow that, or do you expect to grow in the same range in the medium term?
We'll be going faster than that.
How much faster?
I guess we'll find out.
Okay, all right. What about exports? That's a part of your business that you would like to grow. It's still very, very minimal. So say in the next 3 years, where does exports as a percentage of the contribution go to? And as you all mentioned, because of this inorganic growth that you all have done, currently the highest amount of dependence is on the two-wheeler space. But you'll gradually start ramping up, the four-wheelers as well as, I think, CV we mentioned the last time around. So what kind of a revenue mix can we look at?
You want to take that?
Sure. So currently we're about 11-12% in the four-wheeler plus commercial vehicle space. So expect to grow, obviously with our significant presence in the two-wheeler industry right now. We believe we can grow faster in the four-wheeler industry, and that's where our future revenues will come.
So from 11%, what is it headed to?
So for 11%, I think it depends on what the complete business also heads to. So it'd be tough to give you a number as to what the mix will be for four-wheelers and commercial vehicles. What we can say with surety is four-wheeler and commercial vehicle will grow much faster as compared to two-wheelers for us as a company going forward.
When you say much faster, is it a multiple or is it a percentage?
It'll be a multiple.
Ideally a multiple, yes.
Ideally a multiple. So suppose 2x, whatever your overall business grows at, this grows at 2x. What does this do to your margins? Because, realizations in four-wheelers are higher. You realize a lot better in terms of the value that you provide there because the overall price of two-wheelers and four-wheelers, four-wheelers and CVs are a lot higher than that of two-wheelers and premiumization too. Your margins in the past have been in that 12 to 14% band. Do you see that increasing to say 14 to 16% and thereafter maybe beyond that higher? Do you all have plans?
So margins-wise, I think we're comfortable at the current margins that we've been. I think last couple of years we've been around that 12.5 to 13% blended EBITDA percentage across all of our businesses, including manufacturing and trading. So I think that's an EBITDA band that we're comfortable with. I think four-wheelers, commercial vehicles may have a potential upside in terms of the EBITDA, but the fundamental challenge over there continues to be volumes across OEMs. So there's a lot of up and down happening between OEMs in the top 7-8 OEMs. So if the volumes do well, there can be a potential upside. But for now, we think we're quite comfortable with the 12.5 to 13% band that we are at right now.
Okay, and exports is the margin accretive business?
Exports is a margin accretive business.
Right.
Okay, and where is that number headed as a percentage of the mix?
We don't have imminent plans for exports to, reach a certain number. I think a lot of it will evolve based on geopolitical situations. For us to give a number before understanding how India is, trading with the world is critical to understand. I think over the next few months there'll be more clarity. Based on that, I think we will further fine-tune our strategy and thus be able to make more informed decisions about what type of geographies we want to work in and what type of customers we want to work with.
Okay.
There's two things I can say. One is we don't have...
Please go ahead.
One, we don't have direct exports to the US, so that allows us to. So the US tariffs don't really affect us directly. And secondly, we have exports to Europe, and just the US, the UK India FTA that is coming into play will help us to grow in that space as well. So two positives on the export front.
Right. If you could give us this number, and this is something that we had asked of y'all when y'all joined us when the IPO was opening as well. This is just to understand your growth going forward. Is that earlier you had a certain realization per vehicle. Over the last 5 years, how has that increased per vehicle in terms of the product offerings that y'all have increased to your clients? And how is that likely to grow? Yes, on the one hand, your growth will be predicated on how the industry grows and how you'll get more products coming in for newer vehicles, etc. But how much of your growth will come from you increasing your contribution to the same vehicle going forward?
Correct. So content per vehicle has gone up by a fair bit in the past.
Would you quantify that?
I mean, maybe by close to 40 to 45% over the past 7 to 8 years. Going forward, we have a slew of new product launches or new components that we are offering to our OEMs, including steering column, some filtration products. We are working a lot with premium vehicle segments in the two-wheeler segment. So we cross almost all of the premium bike makers in the country, and there's a trend towards premiumization that's happening in the past 5 years. People are wanting to spend more on discretionary needs in a two-wheeler. People want to buy a high CC bike that serves a purpose beyond just a necessity. So I think with premiumization, our content per vehicle will also go up because, of course, with premiumization, there is a higher aesthetic quality required on our components, which in general increases content per vehicle. And apart from that, the size and weight of the vehicle, of the components also go up, due to which, again, content per vehicle increases. So a couple of those factors will allow us to continuously increase our content per vehicle going ahead.
All right. So, Sumit, I'll have to ask you this because you aren't giving us actual numbers. So, hypothetically, the next 100 rupees of sale, if you had to break it up, how much of that would come from the industry growing? How much of that would come from you increasing your, offerings to newer vehicles, say four-wheelers and CVs? How much of that would be via exports, and how much of that would be via, premiumization and contribution per vehicle? If I had to break it up that way.
So we're unable to kind of go into that detail at this point of time. I think it'll be a work in progress as we, increase our content per vehicle, increase the number of OEMs, and increase our exports in the future. I think, the focus remains on outperforming the industry consistently. We've done it in the past as a track record. We'll want to continue doing it consistently in the future also. And as you mentioned, I think the four-wheeler commercial vehicle segment will grow at a multiple as compared to two-wheeler segment going forward.
Okay, all right, gentlemen. Thanks a lot for joining in. Being quite tight-lipped, I would say. But maybe on the next earnings, we remain in hope that, in fact, you'll give us more details. For the time being, enjoy the day, enjoy the evening. It's a great day for you, company. Regards to your father as well, as he was quite passionate when he was talking about the business. Thanks a lot for joining in. Well, time to slip into a short break. On the other side, we'll be joined by the Managing Director of Triveni Engineering. Stay with us.
Welcome back. Triveni Engineering, that's the stock on our radar, up over 7.5% as the company reported their fourth quarter performance. The revenue growth at 25%, although there was some contraction in the margins on account of the ethanol business. Tarun Sawhney, who's the Vice Chairman and Managing Director of Triveni Engineering, joins in now to discuss the numbers. Tarun, a lot to speak with you on sugar, on ethanol, on procurement and engineering as well. So let's start with sugar. The street likes what you've said in your performance and what you've done as well. You've seen a near 10% increase in consolidated crush, whereas the industry-wide numbers were a lot lower. How did you manage that, and how sustainable is that? That's point number one. And secondly, your sugar inventory was 37.5 rupees per kg, realizations at 41. Is all of that in the price, or is there more scope for margin improvement going forward? So on these two parameters, we'd like your thoughts first.
Good morning. Yes, we're very satisfied with our Q4 performance. It was a challenging year in many respects, but Q4 certainly had a lot of positives, and it also bears well for the immediate future. Now, answering your questions, of course, we had acquired a company during the course of the previous fiscal year, and as a result, of course, that led to a higher total crush number. But on a standalone basis, our crush was, broadly speaking, the same. I think that was still significantly better than the bulk of the industry. We were right at the very top. And I think that was because of years of driven sugarcane development activities that we have across our 7 and now 8 sugar factories. So I think going forward, I do see good signs for sugarcane production this off-season. The rains forecast are significantly higher than the long-term average. That, frankly speaking, as long as it happens over an even period of time, should not be a concern. In fact, it should be a positive. So everything bodes well for the future, and I think the past has been quite comforting. Um, I'm sorry, your second question?
Your realizations here and your inventory. Inventory was what, 37.5 rupees per kg, realizations 41.
Right.
Is that all in the price, or there's further room for margin improvement here?
I think going forward, of course, we're in a lean season right now. This is when the bulk of the consumption of the country happens. Prices are always a little soft as we go into the summer, and then they pick up during the holiday season, August, September, and October. I think that there is a little bit of scope for prices to improve. And I think that they do need to increase a little bit, because the long-term averages are actually reasonably disappointing. If you look at 5 or 6 years, the expansion in pricing for sugar as a commodity has been very, very poor. So what we've seen over the last 4 months or 5 months is actually a function, of course, of the balance sheet in the nation. And I think there is scope for a little bit of margin, a little bit of improvement in pricing.
Okay, all right. Hi, Tarun. Good to see you win. Well, the alcohol business profitability has got impacted a little bit, but I think the street is a little bit optimistic on a recovery. Could you tell us what is your procurement strategy and what kind of impact will it have on the margins in the business?
You've asked $1 million question. The challenge in fiscal 24-25 has really been the ethanol business. We've been squeezed from both ends. So you've seen higher raw material procurement prices, the price of molasses that has been procured or even transferred to our distillery has been at a higher base. And of course, we procure an equal quantum of grain, be it maize or rice, from the open market, and those prices have also risen quite substantially as there's been pressure on the system and a new player, the ethanol industry procuring a very large quantum of maize across the nation. Now, I think that has actually impacted the profitability of this business in the year under review. However, going forward, I think what we're seeing is that there are new varieties of maize. There's been better planting, better yields that are coming in on maize, and we've seen the price of maize actually decline quite nicely, as we've seen the UP crop at this particular point is being harvested, and we're seeing prices come down quite nicely. So the scope for margin improvement in Q1 is certainly there as far as maize or ethanol produced from maize. However, going forward, I think it's a very difficult scenario. I think procurement strategies are going to be absolutely critical. The fact that we have to employ better warehousing, better storage strategies in terms of ensuring that we can eke out every last percentage of improvement of margin is going to be the name of the game, and that's going to separate the more successful people in the ethanol business going forward.
You preempted my next question, actually. You said procurement strategy. Remember, maize a year ago was 33%, and now it's 51%. What's your procurement strategy going to be here? And to that extent, what is the kind of margin improvement that you see in this year? Last year, you did sub-double digits. Do you think you can go back to above double digits for starters and then maybe look at, low teens to mid-teens towards the end of this year?
I won't comment on the margin, but I think that because that's very difficult. It's a crystal ball. It really depends on where the pricing goes. It depends on, you see, we have ethanol prices that have already been set until the end of October of this year. So 5 months of this calendar year will be with the new ethanol pricing. The hope, of course, is that there will be some increase after 24 months, because for the last 2 years, we've had absolutely no increase in broad pricing as far as ethanol is concerned. So if we do have some increase, then of course that will lead to an expansion in margin. I think that is essential. But let me just pivot the question. As you all know, Niti Aayog has been mandated with looking at what's beyond E20. We've touched E20 pretty much. We're right about there, and we've done this in advance of the Honorable Prime Minister's agenda, which is a huge achievement for the nation. Now, the question, of course, is what beyond it? For any additional ethanol expansion for the nation, we will have to have brand new capital investment. Thousands and thousands of crores need to be invested. For that to happen, we need to have attractive margins. Otherwise, that conundrum, of course, will be there as how will we get the ethanol for beyond 20%? So when we find answers to that question and actually have the mandate for the quantum beyond 20%, I think we will see some margin improvement. And that is my hope for the immediate future for this industry.
All right, Tarun, you've commissioned, I think, a new distillery. So if you could give us a few details. What kind of utilization levels is it functioning at? If you could tell us what kind of ramp up are you looking at, which would entail what is the volume target for FY26 with this new distillery in comparison to FY25?
Right. I think the quantum of volume is going to be just marginally higher, single-digit increase in terms of the total quantum of ethanol production, because this distillery did operate for the majority of the last fiscal year. I think Q1 was when there was some commissioning happening, and perhaps the utilization levels weren't at 100% capacity. But for the remainder of the year, we've operated at near peak capacities. So the incremental increase in total quantum of ethanol is going to be marginal for the group. However, I think the balance is really going to be the procurement, the strategies of balancing rice versus maize versus molasses versus and the two different streams of molasses, B heavy and C molasses, and trying to actually look at a maximization of margins. At Triveni, 60% of our distillation capacity is multi-fuel. So we have the flexibility of changing streams between molasses and grain, and that offers great flexibility. And I think going forward, that is really going to be very important in terms of maximization of results.
And basis your current strategy, how much in terms of cost savings are you expecting on account of these procurement strategy shifts?
So, I won't take all the credit for it. I think the reduction in grain prices is certainly contributing towards the expansion of margins in this quarter. And going forward, if we can see better grain prices, I think that will certainly add to profitability. However, the strategies of storing well, the strategies of maximizing the DDGS, the effluent from grain distilleries is sold as animal feed across the nation. So it has considerable value. And the strategies in terms of developing better quality of this animal feed will certainly expand margins. So there are many moving parts at this particular point. It is a young industry. It's received a tremendous amount of support, but it still requires a lot more support, especially with respect to pricing and with respect to feedstock development on the other hand. But I think there are good things to come. And it will certainly help in terms of better quality of emissions and air quality, and of course saving foreign exchange at this very precarious time.
All right, very quickly, Tarun, before we let you go, you were merging one entity into the core business and you were demerging the power business as well. What are the timelines for this particular demerger, and how do you see that business ramping up?
Right. So we're awaiting SEBI approval. It's a process-driven strategy, and at this particular point, we're waiting for SEBI approval. Post which we then go to NCLT for the other approvals. But I think we're broadly speaking on track. We had anticipated that by the end of this calendar year, early into the next calendar year, we will have this merger and separation, vertical demerger of our power transmission business. The power transmission business, as you asked, actually has done very, very well. So in Q4, we grew it. The quarter-on-quarter growth was over 55%, driven by exports. We're seeing a huge amount of growth over there, especially as far as our European customers are concerned. On the domestic side, yes, there is growth, but it's moving at a different pace. So the market, our canvas having broadened, and now our addressable canvas being a global one, has really allowed us to expand this.
Right. Roughly, what kind of order inflow are you expecting in FY26 on this business? And also the defense business, because you've already gotten a second propulsion gearbox order from MDL. What kind of expectations do you have for FY26? Quickly before we let you go.
Right. So I think, we don't typically give advanced estimates, but for the year gone by, we had almost 500 crores of order booking, 475 crores of order booking in the power transmission business, which includes the defense business. And I think that is a sure sign of what one can expect. That type of growth is what one can expect in this fiscal year as well. Both businesses are doing very well. I think the push on defense has been very exciting. Our majority of our business is with the Indian Navy, which is investing very heavily in capital ships, and we support the mechanical side of it, all the way from gearboxes to shaft lines to stabilizers, etc. The list goes on. So, exciting times, and I think that of course will, private sector participation in defense is just beginning. It's the inception. So I see a lot of positivity going forward.
All right, all round positive news coming in from you. Good numbers, but they can get better with regards to sugar realizations, with regards to your margins in the ethanol business, and more importantly, a better outflow is what you're expecting in terms of orders coming in from the government on both power transmission and defense. The street likes that. Stock up. Wish you good luck for FY26.
Thank you.
With that, we wrap up on this edition of Chartbusters. Stay tuned. Trading Hour comes up next. Thank you for watching.